A $3 billion lifeline gone in days. When this collapses, the world feels the shock. What does this mean for the U.S., China, and you? Today, we dig deep into one of the biggest financial shifts of recent times. You will learn why a huge chunk of U.S. government debt is losing its anchor. What is really happening behind the numbers? How this could ripple out to global markets and possibly impact ordinary people worldwide? You will discover lesser-known facts. How foreign holdings of U.S. Treasuries have quietly changed in 2025, how one of the world's biggest holders has slipped from its former position, and what that shift suggests about stability, confidence, and the future of global finance. We will also explain what forces economic, political, and strategic are pushing this collapse and why the U.S. might be turning to its biggest rival for help. Spoiler, it is not just about numbers. It is about trust, power, and changing financial alliances. Stay with me to the end because by the final minute, you will understand why this is more than just debt numbers. It is a warning, a turning point, and maybe a preview of what comes next. Welcome to our channel. If you want more deep dives like this, hit subscribe and ring the bell. Scott Bessent took office in early 2025 as the 79th Secretary of the Treasury. Before this role, he spent decades working in global finance, managing hedge funds, advising major investors, and traveling to dozens of countries. As Treasury Secretary, Bessent now oversees the full financial machinery of the United States government. His duty: steer the national economy, manage federal debt, and safeguard the financial system against global shocks and economic threats. When we talk about a Treasury lifeline, we mean something huge. The lifeline is the massive web of debt and bond market liquidity that underpins the U.S. economy. The U.S. issues government debt, Treasury, bonds, and notes to raise money. Foreign governments, central banks, and global investors often buy these treasuries. Their purchases supply the U.S. government with the funds it needs to operate, pay debts, and finance public spending. In return, buyers get a relatively safe investment backed by the world's largest economy. This foreign participation, especially from big players abroad, keeps demand strong. That helps keep interest rates lower and confidence in U.S. debt high. Historically, China has been one of the largest foreign holders of U.S. treasuries. For many years, it held well over $1 trillion in U.S. debt. That made China a key anchor in the global U.S. debt market, a pillar supporting the flow of capital into U.S. government securities. But over the years, China has gradually cut back. As of early 2025, its holdings dropped to around $34 of $1 trillion. Meanwhile, other foreign holders from different countries, funds, or financial centers have partly replaced China's role. This shift matters. When a major buyer like China reduces its holdings, the stability of the lifeline weakens. Less demand means the U.S. must attract other buyers to maintain its debt market. For Bess and his Treasury team, managing this transition, finding new buyers, balancing supply and demand, controlling interest rates becomes a strategic challenge. In this scenario, the role of Scott Bessent looms large. He is not just managing numbers. He must navigate shifting global alliances, changing investor behavior, and economic uncertainty. Treasuries are no longer just about paying bills. They reflect global trust in U.S. debt. And when that trust shifts, the consequences ripple far beyond Washington. Recent data reveal a sharp drop in China's holdings of U.S. treasuries. At its peak, China held over $13 trillion in U.S. government debt. In 2025, those holdings have fallen to roughly $700 $760 billion. In fact, by July 2025, China reportedly cut its holdings to about $730 billion. Yes, $7 billion. The lowest level since 2009. This decline has taken place even as total foreign holdings of U.S. treasuries surged to record highs. In other words, while other foreign investors, institutions, central banks, or funds are still buying some U.S. debt, China is stepping back. The implications of this shift are substantial. First, fewer purchases from a major buyer means reduced demand for U.S. debt. When demand weakens, bond prices tend to fall, which pushes yields up for the U.S. government. That means higher borrowing costs whenever it issues new debt or rolls over maturing debt. But the effects do not stop there. Because U.S. Treasury yields serve as a benchmark, rising yields tend to push up interest rates across the economy. That can lead to higher mortgage rates, more expensive loans for businesses, and increased borrowing costs for consumers. Beyond financial mechanics, there is another: risk confidence. U.S. Treasuries have long been viewed as a safe haven, a rock-solid investment that underpins global trust in the U.S. dollar and U.S. debt. When a large holder like China steadily pulls back, that perception weakens. If investors start to question whether treasuries remain a safe anchor, many may look for alternatives in other currencies, gold or other sovereign bonds. In that sense, this reduction is not just a number shrinking on a spreadsheet. It signals shifting global priorities, risk evaluation of risk, and a more uncertain foundation for U.S. debt. For policymakers and investors alike, the tides have quietly begun to change, and the consequences could ripple far beyond Wall Street. In early 2025, Scott Bessent, U.S. Treasury Secretary, held a high-level call with He Liang, Vice Premier of China, to discuss the fragile economic and trade ties between their nations. On that call, they addressed serious topics: trade imbalances, tariffs, economic pressure, and the overall state of bilateral economic relations. U.S. Department of the Treasury +2, Business Standard +2. The tone of those talks was urgent. On the U.S. side, Bessent raised concerns not only about trade restrictions, but also about global economic stability and the potential ripple effects if China continued trimming its holdings or further retaliating with tariffs. From the U.S. perspective, these diplomatic overtures carry clear motivations. The government needs to keep liquidity flowing. That means ensuring demand for U.S. government debt remains strong. Lower demand would push up borrowing costs, which could destabilize not just government financing, but also interest rates across mortgages, corporate loans, and consumer credit. At the same time, the U.S. wants to avoid renewed economic instability. With global markets jittery, rising tension with China could undermine confidence in U.S. debt as a safe haven. By pressing China, one of the world's largest foreign holders, to stay engaged, the U.S. aims to preserve stability, reassure investors, and keep borrowing costs manageable. Seen against the backdrop of sliding Chinese treasury holdings and rising global uncertainty, these talks read less like normal negotiations and more like an urgent appeal, a bid to shore up support before the damage gets worse. China has been pursuing a careful long-term strategy to reduce its dependence on U.S. dollar assets. For years, the country relied heavily on U.S. treasuries as a safe and liquid investment. But in recent times, it has increasingly diversified its foreign reserves. China now holds a growing share of non-treasury bonds, investments in other currencies, and tangible assets such as gold. This diversification allows China to spread risk, strengthen its financial independence, and prepare for potential global economic shocks. At the same time, China faces serious domestic economic challenges that make massive foreign debt holdings less attractive. The country carries a significant debt burden across government, corporate, and local sectors. Its property market has been struggling for years, with developers defaulting on loans and construction projects stalling, creating uncertainty for investors. Meanwhile, the Chinese government is implementing domestic reforms aimed at stabilizing the economy, curbing excessive debt, and ensuring sustainable growth. These measures often require keeping liquidity at home rather than investing heavily in foreign assets like U.S. treasuries. These domestic pressures, combined with a deliberate diversification strategy, suggests that China might be unwilling or even unable to act as the buyer of last resort for U.S. debt markets. In other words, the country is no longer in a position politically or economically to guarantee stability by continuing to purchase vast quantities of U.S. government bonds. This shift reflects a broader trend in global finance. Major players are increasingly balancing national economic priorities against international obligations. The combination of a deliberate move away from dollar assets and pressing domestic challenges highlights why U.S. Treasury markets are entering a period of uncertainty. China's role is changing, and its past support for U.S. debt can no longer be taken for granted. As China and other major holders reduce their purchases of U.S. Treasuries, borrowing costs for the U.S. government are likely to rise. When yields on Treasuries increase, it sets off a chain reaction across the entire financial system. Mortgage rates climb, making home loans more expensive for American families. Consumer loans become costlier, affecting car loans, personal credit, and business financing. Companies face higher interest on corporate bonds, potentially slowing investment, hiring, and expansion plans. Global bond markets could see significant volatility as investors react to these shifts. A decline in demand from traditional buyers like China creates uncertainty, prompting other investors to reassess the safety and stability of U.S. debt. This could trigger swings in bond prices, creating ripple effects for stock markets and other financial instruments linked to interest rates. The U.S. dollar's role as the world's primary reserve currency could also be challenged. If major holders of treasuries decide to diversify or sell off large amounts, confidence in the dollar may waver. Countries and institutions that rely on U.S. debt as a stable asset may start shifting toward other currencies or investments, further testing the dollar's global dominance. These changes are not contained within financial markets alone. They have broad international implications. Investors around the world may begin reevaluating what counts as a safe asset, moving capital into alternatives such as gold, other sovereign bonds, or different currencies. Trade flows and global investment patterns could be disrupted as countries adjust to higher borrowing costs and financial uncertainty. Businesses reliant on cross-border financing may encounter higher costs, and emerging markets in particular could feel the strain as capital becomes more expensive and volatile. The combined effect of rising U.S. borrowing costs, bond market volatility, and potential shifts in the dollar's role could reshape global financial stability. Investors, governments, and everyday people alike may feel the impact as economic decisions become more expensive and markets grow less predictable. One possible scenario is that the United States manages to attract new buyers for its treasuries. These buyers could include other countries, large institutional investors, or sovereign wealth funds looking for safe long-term returns. If demand stabilizes, the treasury market could recover, keeping interest rates relatively steady. Borrowing costs for the U.S. government would remain manageable, and the broader economy might avoid major disruption. Investors and businesses would gain confidence from seeing stability return, and the ripple effects through mortgages, loans, and corporate borrowing could be contained. In this scenario, global financial markets would breathe a sigh of relief, and the United States could maintain its economic leverage. A second scenario envisions a further sell-off or a continued refusal by China to participate. If China and other large holders scale back aggressively or dump treasuries in significant volumes, interest rates could spike rapidly. Higher rates would increase borrowing costs across the board, affecting everything from home loans to corporate debt. Consumer spending could slow, businesses might delay investments, and government financing would become more expensive. The shock could extend globally as investors reevaluate risk and capital flows, triggering volatility in bond markets, equities, and currency exchange rates. Countries that rely heavily on U.S. debt as a benchmark might struggle to find alternatives, amplifying the economic strain. A third scenario involves a diplomatic or economic deal between the United States and China. Such an agreement could include compromises, concessions, or financial incentives to encourage China to continue buying treasuries or to restore confidence in the market. Friendly nations or other major investors might also be drawn in, helping to stabilize demand. These deals could involve adjustments in trade policy, tariff reductions, or coordinated financial planning. If successful, the United States could secure a temporary lifeline, slowing interest rate growth and restoring a sense of predictability. While uncertainty would remain, strategic negotiations could prevent a full-scale market disruption and signal that the U.S. can navigate complex global economic relationships. Each of these scenarios carries significant implications not only for the United States, but for the global economy. The choices of major holders, the reactions of investors, and the effectiveness of U.S. economic diplomacy will shape the next phase of financial stability, interest rates, and market confidence worldwide. Here is a script section for the recap and audience engagement written to flow naturally and expand on the points. The massive lifeline that has supported U.S. Treasury markets for decades is shrinking. What once seemed rock solid and dependable, Treasury seen as the ultimate safe investment, is now under pressure. Foreign buyers, particularly China, have reduced their holdings, and global investors are reassessing the risks. This shift shows that even markets considered stable can become fragile when trust and confidence begin to waver. The broader lesson is clear. Global financial stability relies on far more than just the numbers on a balance sheet. Geopolitics, strategic decisions, domestic economic pressures, and investor psychology all play crucial roles. When major players change course, it can send ripples through the financial system, affecting markets, economies, and ultimately the lives of ordinary people. Interest rates rise, loans become more expensive, home buyers face higher mortgage costs, and businesses may hold off on expansion. Prices of goods and services could climb, and jobs could be impacted as economic uncertainty spreads. These developments make it evident that financial security is interconnected on a global scale. Decisions made by governments and investors in one part of the world can have immediate and tangible consequences elsewhere. It is not only policymakers and large institutions who are affected. Everyone who borrows money, invests, or spends in the economy could feel the effects of these shifts. We want to hear your thoughts. Do you think the United States can recover from these challenges, stabilize the Treasury market, and maintain global confidence? Or is this just the beginning of a deeper, more systemic financial crisis? Your perspective matters because these events, while complex, ultimately touch all of our lives in ways that are often unseen until they arrive. That brings us to the end of today's breakdown. We want to hear from you. Do you think the United States can bounce back, or are we witnessing the start of a bigger global financial shift? Share your thoughts in the comments below. If you want more clear, in-depth analysis of global economic events and what they mean for you, make sure to like this video, subscribe to our channel, and hit the bell so you never miss an update. Your support helps us keep bringing these insights straight to